Good morning, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. One last look at that disclaimer. And let's welcome Dimitri Pargamonic to the stage. How you doing, D?
Good morning, Will. How are you?
Great. So what are we going to be looking at today?
Yeah, I'm going to set up a ratio put spread, and then we're going to take a look at, how to set one up and how to then analyze that put spread based on different risk parameters. We're going to look at, how time decay can impact the strategy and implied volatility assumptions. So let's first set it up, and then we'll start, discussing those aspects of a ratio put spread. So I'm going to first go to SPY. We'll use that as our example. Type in the symbol up top. You land on this main SPY summary page on the left-hand side. There's a menu. We're going to click on options and option chain, and we're going to use the option chain to set up our ratio put spread. I'm going to close this menu by clicking on it and expanding the screen. And for our purposes, what we want to do is look after we create a ratio put spread. We want to see, how does time decay impact it, and how sensitive is the strategy to changes in implied volatility. And to do that, let's go out further in time because we want to test out the time decay. So let's pick a expiration that goes out a little bit further. Let's go to, maybe do something like June 25. Let's try that one. So click on the expiration. These are on the left-hand side. The expirations available in SPY to trade. Right now we're on June 20th. So we have about, you could see 21 trading days, 31 calendar days until expiration. And a ratio put spread is what it is. It's like a traditional vertical put spread with an additional option. And what we'll do is set up a ratio of 1/2. So instead of 1/1, it'll be 1/2. So let's first, when we're looking at the options chain, on the left-hand side, we have calls, and on the right-hand side, we have puts. So since we're looking at the puts in our example, we're going to focus on this right-hand side, and these are the strikes. So let's first do a out of the money put spread. Okay, so I'm going to go down in strikes, and I'm just going to pick some random. So here's a put 3% out of the money. So let's first put on a put spread. I'm going to click on the ask side, and when you do that, you see this ticket come up, buying the June 20th 575 put for $5.11, which is the price of the ask. You could change these parameters, but this is defaulted to. If you click on the ask, it comes up with a assumption that you're looking to pay the offer and buy the ask. Okay, and you could switch that if you need to, but we're going to leave that on the buy side. To complete the put spread, we need to sell a put. So we're going to go out further, and let's do a $10 put spread. So I'm going to look at the 565 put, and I'm going to click on the bid. And when I did that, now you see the second ticket come up, selling the June 20th 565 put for $3.54, which is the price of that bid. So this is a traditional put spread, right? If you run an analysis here, what this looks like is like this, a put spread, right? Vertical put spread. But since we're doing a ratio, we need an extra put, an extra leg. So for our example, I'm going to do a extra selling of the 565 put. So click on this ratio, and now we got a 1/2. So we're buying the June 575 put, one, and then selling the 565 put twice. The idea there is, well, we think that if the stock falls, our assumption based on this strategy would be, well, if the stock falls, it could drop, but we believe that around the 565 level, that's, you know, our estimate that it won't go any further than that, you know. So we sold an extra put. Okay, and if we run that analysis, now this is how the payout diagram looks like at expiration. So why does it look like this? Well, if we bought one put for $5.11 and sold two puts for $3.54, well, we get this credit of $1.97. And if the stock, here's the payout diagram, stays above 575, well, both puts will expire worthless, and then we keep that credit. So in our situation, we did it for credit. If the stock drops below 575 at expiration, well, we're okay until it gets up to the 565 strike, right? That's our ideal, because the 575 put we bought would be in the money. And at 565, exactly 565 will be, you know, $10 in the money, and the puts that we sold would expire worthless. However, if it falls below 565, now we have that extra put to worry about, and you can see eventually we would start losing on that extra put. And the question is, well, how do we test the sensitivity of these options prior to expiration? We see how it looks like at expiration, but, you know, there's between now and expiration, the stock could be moving around, implied volatility could be moving around, and then we have like decay. You know, what does it look like tomorrow, the next day? So this is something we want to now take a look at and see how sensitive is this position, you know, between now and expiration to these changing parameters. So I'm going to come up here on the summary. We're going to click on this, and we're going to click on pricing and risk sensitivity. And once you click on it, you come to this new page, and here's the original strategy that we set up: buying one June 575 put, selling two June 565 puts. Okay, and the original inputs are that there's 31 days to expiration. These are the implied volatilities based on, you know, those market prices that we set up. This is the interest rate assumption. And here's the original strategy. We get a credit of $1.97. This is the delta, gamma, Vega, Theta, and Bro. And if we come down here, we get this graph. And the graph shows us that if nothing else changes on the day, right, implied volatility and stays the same, and Theta, just the stock moves, how does this strategy look like? So you could see that this strategy gains as the stock moves up, okay, and loses as the stock moves down. That's the expectation. And keep in mind, because it's not expiration yet, so it has a delta, right? It has a positive delta, 1086. So from the outset, with implied vol is the same. This strategy looks like, you know, as the stock moves down on today, this would be expected to lose, because you do have you have one extra put that you sold. But how does this look like if we moved forward in time? So we need to keep this and compare it. So what I'm going to do is take these days to expiration, and I'm going to say, you know what, that's today. How do things look like if we went forward in time? And let's say, we have all the way till June 20th. How does this look like on May 30th? So I'm going to click May 30th. And by doing that, I moved forward 10 days. See, so now I'm like subtracting 10 days from it. So on May 30th, if we keep the implied vols the same, so interest rates the same, now what we have is a time decay. These options now have, less value with the same implied volatility because they have less days to expiration. So let's run that analysis and make a comparison. So here it is on May 30th. We see that this strategy would be worth 66 cents. Well, if you get a credit of $1.97 and now it's worth 66 cents, that means you gained, right? That it was profitable from that point of view because look, you have a positive theta, right? Every day you have $12 positive theta, right? So your theta started out positive. So if nothing else changes, stock stays at the same spot, implied volatilities stay the same. We move forward 10 days. Now it's worth 66 cents. What if the stock moves around? Well, this is what this comparison is. So you could see here today, this strategy, if the stock SPY moves down 1%, it will lose almost $48. However, if it moves down 1%, if on May 30th the stock is down 1%, it's actually a gain of $85. So we went from a loss to a gain because now we had time decay. The options are worth less. Okay, so we could see our sensitivity now that as time goes on around this area, right around this area, it is good for us because we're long theta and there's decay, positive decay. But what if implied vols change? Look, what if the implied volatilities don't stay the same? So we could go here and check that, and we could see here we are short Vega. So if implied vols move down in both, that's good for us. If they move up, it's bad for us. So let's assume that we have time decay, but we think that let's test our risk in time decay and say, well, what if time decay works for us, but implied volatilities change and move against us by one volatility click? So then on each option. So if we click this up, so you see now I increased it by 1 from the original. And let's increase this by 1. So now I increase this one by 1 as well. So let's run this analysis. So we get a little bit of a different picture now. That we still had time decay work in our favor. So it went from a credit of $1.97, now it's worth 83 cents. So if we collect the $1.97, if we could buy it back for 83 cents, that's a profit. So that still looks good, but here, on the upside, we're still good. On the downside, at 1%, we're still good. Instead of losing $48 on the day, we'd be making $56 in 10 days, even with one vol click moving higher. At 2%, we're losing, not as much as on the day. And you could see here now how sensitive those risk parameters are to the position. What if it went for us? Instead of $56, let's see if implied volatility is actually declined by 1. So I'm going to now decrease it by 1. Okay. And I'm going to decrease this one by 1. We're just going to say they went down proportionally for our example. Now we're seeing 56 and 113, right? If we stay at 0, it's a $113 profit, down 1%, 56. Let's see how that changes when we now move down one vol click. So here you see that now the position zone would be worth 48 cents with everything unchanged. So that translates to a bigger gain, right? Because now if you sold it for X amount and you're buying it back cheaper, that's a bigger profit. And you could see down 1%, you're estimated to make 113, down 2%, you're estimated to make $64 in 10 days, with 10 days of decay and implied volatility moving down versus today losing 160 with implied volatility staying the same. So that's a quick example of setting up a ratio put spread and then testing out the sensitivities of that put spread to time decay and implied volatility changes using the option pricing model. So Will, I think I'm going to stop right there.
Yeah, that was great, D. Thanks for bringing that to the Chameleon community. Just we had an email from one of our regulars yesterday with confusion because the show wasn't live. On days where we have things that either come up, sometimes even right before the show starts, we have technical things we got to take care of. We're a tight crew, but yesterday I had a personal family event. It was actually a nephew's graduation, so we didn't have a live show yesterday. But on the days we don't have live shows, I try to produce some content from an older video and repost it, and that's what was available yesterday. I do try to do it at 9 as a premiere, and that allows people to come in and chat if they get on at 9. But that's the best we can do on days where we can't do a live show. And we'll try to continue the live shows as long as we're alive, Dimitri. Hopefully that's a long time. With that, D, as always, great job, my friend. Thanks for bringing this live to the Chameleon community. Everyone have a great, safe day. Thanks, D.
Thanks, everyone. Stay safe out there and have a great trading day.
Trade in peace, Chameleons. Everyone have a great day. Thanks.